Hello.
Oh, good. We actually have
Our phones are ringing.
Our phones are ringing. So we're live, apparently. Hi, I'm Bill Fairman. This is
Bye-bye,
Wendy
sell,
Sweet.
sell.
And
Jonathan
Sorry.
Davis. Wendy throwing in there and always messing me up.
Sorry, everything I can do.
Carolina Capital Management. This is our kind of market update, ask an ugly question
Session.
segment.
That's right.
So if you like any information on us, it's carolinahardmoney.com. If you're a borrower, click on the borrower tab. If you're an investor and you're interested in passive returns, click on the investor tab. Don't forget to share, like, subscribe.
Tell all your friends. And now we're on Twitter, right? Is
Are
that
we?
what Scott was saying?
Periscope.
Periscope, which is a part of Twitter.
Okay.
I think that's what he said.
I'm an
Not if that's true, Scott.
I'm an old fart, so I don't.
He's nodding. Yes, it's true.
So that being said, if you guys have a question for us, and again, this is the ugly question segment, we already have two really good questions we're going to answer.
That are way better than anybody else could think of.
But if you have any of your own, you can go into the chat. Again, it's to the right of our screen. I have no idea what platform you're on and where it would be on yours.
Yeah, could be upside down.
But we will answer that if we can, or if we feel like it.
Okay.
We will answer your questions.
But before we get started, there's a lot of news today on Thursdays. Unemployment numbers came out. The initial claims were a little higher than expected at 1.1 million. They expected around 925. But the continuing claims continue to go down.
Yeah.
And so they were a little bit below expectation.
Good.
So,
that's good.
overall, that's good. But, that's going to happen a lot when you have a lot of fits and starts in different areas of the country.
For sure.
Yeah.
For sure.
Construction jobs.
I know. I put that on your desk yesterday. I
Yeah.
thought that was interesting. I don't think they can read
paper.
that. The Mecklenburg Times.
I'm going to
Yeah, show it to that camera.
hold the Mecklenburg
Is that better?
Times.
Yeah.
Scott, switch over to number 2 for me, please.
He's not there.
Oh. So our producer has left the building. Nice.
Dang, the one time we would have an opportunity to
and we
use
can't
the
even-
different camera angles that we have.
And we can't
He's
holler at him
gone.
because he's not even actually
He
in the building.
he goes and gets lunch when we do that. It's
That's
just a
what
little
the bell
break.
was
That's
that
right.
We heard
That's
at the very
right.
beginning. Okay.
We thought it was
so
a phone call.
So Mecklenburg Times.
we're
Yeah.
back to what we were talking about. Mecklenburg Times is a local paper. If
Anyway,
you're in-
the headline is construction adds 20,000 new jobs,
yes,
but commercial drops in the jobs that they're doing it. So it's
non-residential construction jobs are actually going down. And
Right.
that makes sense.
Mhm.
right.
You have municipalities that cannot collect enough money,
To pay for what they were doing
and so they're going
Right.
to have to. Well, they'll finish the projects that are already earmarked. But
at an already slower pace,
they're-
right?
I mean, they have to. They've already budgeted.
That's
for it.
right.
It's
That's
just,
right.
Any new budgets are going to be screwed because they're not getting the revenues
Right.
that they thought,
Right.
especially when half the businesses are not producing
Yep.
sales tax.
Yep. Hurts
like
everybody.
they were.
Yeah.
The good news
Sales tax
is
hurts a lot.
a lot of those people will be able to go over into the residential side of things,
Hopefully.
unless you're a heavy crane operator.
Yeah.
That might not work.
Yeah.
But hey, you can always put mobile homes together.
That's correct. That's correct.
Double wides.
So what about the mortgage applications? You were talking about that earlier as well.
Mortgage application volume for this week down 3.3%.
So my first
from the
thought,
previous week.
on that was that it was because of that 0.5 point tax that was put on the refinances. But you also mentioned that the rates were a little bit higher.
Yeah, FHA went up initially first, and then Fannie Freddie are following suit. They're putting a refinance. The Fannie Freddie is a refinances. The FHA is all loans.
Right.
Mhm.
But part of the reason is they want to try to slow down the refinances too.
Right.
It doesn't help anyone if you continually refinance. Although in the long run, we had a conversation with Aaron about that.
Aaron Chapman.
And
right.
what does that do if you're constantly refinancing every 5 years? you're constantly paying nothing but interest, and your principal never goes down.
That's right.
So it does keep you
In a bad place.
bound.
I don't know that it's necessary to say a bad place, but yeah, you're still, not reducing your principal amount. Now, if you can get lower rates, I mean, you're again, the 30-year mortgage, you're paying the mortgage with the decreasing value of the dollar. So
Right.
it's still a good thing. It's just not as good.
Plus, you're hoping that your appreciation is going up at the same time.
Mhm.
But
that's
said,
the cherry on top. You
you're-
never
you're
do
always
stuff
gonna be
based
in
on
debt.
that. Right.
Some people, when they're ready to retire, let's just soon not have the debt,
Mm-hmm.
right?
That would be me.
Because it has to be good debt. It has to be income producing debt, not debt on where you live.
Right.
So that just costs you money.
Mm-hmm.
That's just an expense.
Right. That's a good
Although it's a
point.
lower expense at lower rates. Now, that said,
Now,
mortgage rates did go up a little bit too, and the demand for refinance dropped 5% for this week. That said, mortgage applications for purchase money increased by 1%, which doesn't sound like a lot, but it's 27% higher than this time last year.
Right.
wow.
So it is booming.
Well, what I want to, kind of ask the question is, we see when we do investor long-term loans, which are 30-year AMs and not 20-year AMs like you can get with a credit union, they're actually better for cash flow. And they usually carry a 3-year prepayment penalty on it that goes 3% first year, 2% second year, 1% third year, and then it goes away. So my question is, why wouldn't those people who are used to buying the securitizations of homeowners loans not switch over to landlord loans, because they're not going to refinance as often,
Right.
and you're going to have a higher coupon. Like, I feel like that's a market that should be tapped heavier by those securitization firms and those REITs and hedge funds that
The
are
longer term investment loans.
Yeah, the longer term.
Yeah.
Like if you came to me and said, "Hey, do you want to buy this residential owner occupied loan that's a 3.25% rate, and looks like on the horizon rates are probably going to fall over the next 2 years, or do you want to buy this investor landlord loan that's 5.25% rate, and there's a three-year prepayment penalty on it, so even if they do pay off soon, you're going to recoup whatever you pay the premium for."
It's a safer loan. And
So I'm like, why wouldn't they, like, if I had $1 billion to invest and I had
Well,
to,
you don't.
and I had to invest in 30-year mortgages, that's what I would invest in.
that's right. That's
Well-
right. That's a great point, Jonathan.
The problem is most banking,
And they're all run off of the
Or
DSCR. So, I mean, they all cash flow.
Yeah.
but most
Yeah.
people don't understand the real estate investor, the mindset. They tend to think of second homes, because the second home owner is the first person that's going to let a second home go back when things get bad.
Yeah.
Mhm.
But an investor loan is different.
That's right. But being in the mortgage business 30 years, that is what I was always taught. It's your primary residence is the one you're going to hang on to when things get bad.
Yeah. Do you think it's because there are pencil pushers that are making those decisions rather than people who are really in the mortgage business?
Well, I mean, yeah, because I'm thinking about it, I'm looking at it from my perspective, and I get my perspective is very different than a lot of people's. But if I have 4 properties that are cash flowing enough to pay for my primary residence, that mortgage, I'm not going to lose those, no matter what. I'm going to make sure
That's right.
because those take care of this.
That's right.
So
That's right.
That's how I think most investors would think.
Yeah.
So I just wonder if that secondary market is ever going to catch up to that way of thinking.
Yeah.
Well, if you look at the percentage of individual investors that own properties versus REITs or just large investment firms, there's probably somewhere between 75 and 80% of the rental properties are owned by small individuals.
Right.
That have,
Mom and pops.
2, 3, 4 properties.
Mm-hmm.
And in the back of their mind is that once they have a couple of bad experiences, they just give up, and maybe that's the problem.
Right.
Maybe that's what they're thinking.
I don't
They're
know.
either just not experienced enough, or it's not being run by a company, and they're just not as good of a risk as it would be if it was some firm owning them and running them by the numbers only.
Right.
Yeah, and I understand we only know what we know, and I can't, I don't work in that industry in the secondary markets. I mean, I've dabbled in it, but
You work with them.
well,
You sell off a lot of stuff to
so
them.
I've definitely worked with them for sure, but not in that market. So I would like to know
What are you thinking?
What's the thought process?
Yeah.
Because if you have a property, I mean, we know historically rents don't go down.
Right.
So, the same thing that we tell everyone, like if we have to take back our properties, we're going to turn them into rentals.
Yeah.
Like that's what we're going to do. So, I mean, we saw, what was it? Blackstone proved that the model even works. I mean, Blackstone bought, I don't know how many thousands of homes as rentals, and they turned a huge profit off of that.
Yeah.
So I'm just wondering, what's the downside? What am I missing?
Here's the other thing that's really interesting about that is because, when we go to present a long-term investor loan to somebody who's going to finance it for us, they have these guidelines set in place where the loan has to be at least $75,000 and the property has to be worth at least $100,000.
Because they're buying across the nation.
Yeah.
And they, if you buy a $75,000 house in Sacramento, you don't have a house, you have a shack. And
Yeah.
You barely have a shack.
Yeah.
So they're creating these guidelines to cover the whole nation.
Instead of creating the guidelines to cover the area.
Exactly.
Which is kind of crazy because,
Yeah.
in our area, if you're, it's very common to have $100,000 house as a rental property that's making, $1,300-$1,400 a month in rent.
Real estate is local.
Solid.
Yeah, real estate is local. I mean, and there are few big firms that understand that, or at least from their actions that they show us that they understand that.
Yeah.
So I feel like those firms who do understand that are going to be the ones to make a big play.
Yeah.
In the market.
Yeah. So far, there's no one in that spot.
Not yet. Maybe it's us.
I think that's the case.
They do have
So we need lenders for that. Tell all your friends.
Yeah.
they
About
do
$2 billion.
Yeah.
We'll do it.
they do have a box they have to fit them in, because they're going to end up selling them eventually to the secondary market,
Right.
and to investors. And anytime you have an investment, there has to be a lot of black and white to it. And you can't say, well, we're going to lend on this as long as this happens, and then this happens, and then sometimes we'll just take this into account. No, it's got to be in a box.
Well, if you could have
That's
like
why we're in business,
could-
because we don't have to be.
you
in a
could have
box.
like a southeastern box, a northeastern
Yeah,
box,
absolutely.
a Midwest box. So you
Absolutely.
could. I mean, if I was going to do it, that's kind of how I would go about it. And not to make it too complicated, I'd probably make it even more granular than that. I would have, these two states box, North
Right.
and South Carolina box. Then
Right.
I'd have a Georgia and an Alabama box, and Florida would be its own. So
Right.
'cause-
Right. And that's a good point. I mean, you look at
but again, that it comes like, how do you underwrite that? How do you hire people to
that know how to do it.
Yeah,
Yeah.
So that could be an issue.
Yeah, it's a good
Well,
point.
Aaron mentioned that it took him like 5 years to convince the company he works for that the investors are the least risky. Remember?
That's right. Well, and he did it with the numbers. How many loans
made-
are you having to go
Didn't
in
he say
default?
he
only had one.
he had one, and then they had like, what was it, like 10% of their portfolio?
Yeah, and
was
he
it?
had one
he
and
had-
those of loans.
Yeah.
Yeah,
I think
that
it was
was-
1,800.
Yeah,
Yeah.
that was pretty crazy.
So again, just reiterating the points, like landlord or these investor loans,
you're solid.
properly purchased and properly underwritten, they are solid.
Yeah, and that's another good point, is properly purchased. I hate to see people in rental property deeper than 75% of the value.
Mhm.
I hate to see it. I don't care if it's an Airbnb property or just
Well, what's your exit? What's your
36
plan?
That's exactly right.
Yeah.
That's exactly right. And you got to leave room for vacancy and management and expenses. Things are going to go wrong, and you got to leave room for all of that and still make a profit. It's not just about, building the wealth in that property, which is also a really
Well,
good
listen,
point.
as long as you have the liquidity and you have a long-term plan, you can pay more for a house than
Right.
you need to. And the Blackstone, who you just brought up, did that. That was one of the problems
I
when they were
remember that.
buying all
Yeah.
those properties. All the local investors said, I'm not buying those homes for what you're paying for them.
And they said, okay,
and,
we
and they,
will.
And they ended up going to work for them, finding properties for them.
They sure
And
did.
they overbid and they overpaid.
And what
And then they ended up coming
controlling?
out on
On
top,
top, yeah.
because now they had all these properties.
Yeah. Well, that's the whole point. It's like,
Mhm.
you can overpay if you have the ability to purchase the entire neighborhood.
Yeah,
Like, if you buy the whole neighborhood, you now control it.
that's
So,
right.
you get to control your sales comps.
That's right.
And here's the other thing. They bought a ton of the properties, which meant there were fewer properties on the market
Mhm.
for other people to buy. So what did that do?
They created scarcity.
Created scarcity.
Yeah, yeah.
And the prices went up.
Yeah. But the other thing too is, it's all about timing, and there's no way people can really see into the future and know what that timing is like.
Very true.
There could have been another 2008 and they would have lost everything. So
Right.
you just don't know what that timing is. I think some of it has to do with a little bit of luck on the timing of the market on what they did. But they shot for a home run and got one for sure. On that.
And the great news about this is they're not going to dump all their properties either, because as soon as they do, they're going to lower the price that they
That's
get
right.
for those homes that they're going to end up eventually selling.
Yeah, this is important where greed can't come into play. You
Yeah.
have to be smart and look into the future about what you're doing. There's a lot of people that would have been greedy about it and just let it all drop.
Well, speaking of looking into the future, we can get to our first question.
Oh,
here.
yeah.
What is the current and future status outlook of Carolina Capital Management regarding investments, interest rates paid, quality and diversity of projects, average loan size, performance, delinquencies, and defaults?
Geez, that was a long question.
I know.
That's like 5 questions.
I know, but it's a good one.
Disguised as one.
Yeah, but
Well,
it's good.
Yeah, Bill, so what is the status outlook, the current and future of Carolina Capital regarding the investments?
Okay, so we are very optimistic about the market because we are focused on affordable housing.
That's right.
90% of what we do, 90,
Mhm.
maybe more than 90% is single family affordable housing. That is going to continue to go up.
Mhm.
There's a high demand for it. Even if demand drops a little bit, people still need a place to live, and
That's
they're
right.
going to, the affordable housing is going to be the best part for that.
Yeah, we were very, very cautious beginning in January 2019. It was obvious to pretty much everybody that we were going to see a correction in the market.
Yeah.
And we had already been burned on high-end houses. We've been down that road.
They're pretty to look at.
They are very
They're
pretty to look at, and
yeah.
and they're really sexy when you can say, hey, these are the loans that we're doing. Look how great these houses look.
Mhm.
But when it comes down to what the bottom line is all about, what happens if they go into default? How quickly can you sell that? We went through all that. We learned our lesson, and we cut that stuff off.
Yeah, because what wasn't pretty was the days on market.
That's exactly
Yeah.
right. So
You
So-
can make a 2-bedroom, 2-bath cottage
really cute.
sexy too.
That's exactly right. So
I think it's cute. I don't know if I'd go sexy, but it's cute.
It depends on where it is. And
yeah.
if you have a nice little outside.
I think you need at least
Living space.
2,500 square feet to hit sexy.
Yeah. That's the guideline.
So,
That's the guideline. So we were able to turn things around starting in January, and people thought we were crazy for doing it. Our competitors thought we were crazy. The people that we were lending to in the high-end arena were mad at us.
Mhm.
But they found money that they could get. So, it didn't kill us.
And then what did that do for us in 2019?
Well, it set us up to be absolutely ready for when COVID hit in
Yeah.
2020.
And not only ready, so in 2019, we saw
Had the best year we had.
one of our best years,
Yeah.
or maybe the best year,
Yeah.
where we saw an increase of, I believe it was 43% of origination dollars out the door, and an increase of over 50% of units, so number of loans.
And that's while at the same time we lowered our loan amount.
Yep.
Our average loan amount, like almost cut it in half.
Yep.
From what it was.
Yeah. So the average part, that was part of the question. Average loan size was 158,000.
Last year. This year, it's 190,000.
That said, we're doing.
2020, you mean?
2020
Yeah.
is 190.
Yeah,
Correct.
we were looking at 300 or less, and now we're more focused on anything under 4.
Yeah,
Mhm.
because it's still even up until about 500, it's still flying off the market. But we start getting a little queasy when it's over 400,
Well,
and we really are particular about the area that it's in. If it's between 4 and 500, but we won't go over 500 on something.
yeah, and we just had a Banks Dupree just
I just
posted.
talked to him on the phone.
Yeah, he said, "Thanks for believing in my project. We did it."
Awesome.
Yeah.
Awesome.
Yeah.
That's right. I talked to him this morning. Thanks for calling in, Banks. And I appreciate you writing in and listening to us. He's got another deal he wants us to do, some new construction.
And we do like new construction. So that's also part of this is the diversity of projects.
Yeah.
So we're doing about 20% commercial. And when we say commercial, we're talking multifamily.
Not restaurants, not bars.
So it's
no hotels.
No hospitality. Multifamily and warehouse or storage space.
Mm-hmm.
So that's when we say commercial, that's what we're hitting on. And we're doing about 20% of that. 15% of what we're doing is new construction on the single family side.
Mhm.
And then about 65% is fix and flip.
Yeah. And the new construction is strong.
And we would love to do more new construction. I mean, I love new construction. We're in control of the entire process.
Right.
Like, and people need new homes, especially new construction. When we say new construction, again, to go off what
It's still
Wendy said,
affordable.
affordable new construction. So
People that can build a house for $85, $90 a square foot.
Yep.
You can find a good lot for $15,000, $20,000.
mhm.
Get the city water tap. If there's a house that's been on it already, you're saving money there as well.
Yep.
So there's lots of infill lots. There are many infill lots throughout all of the cities in the Southeast that we do loans in, especially the second tier cities. There's a ton of those infill lots.
Mhm.
So that's pretty amazing.
All right. I don't want to forget about the interest rates paid or return, as it were. So from the fund perspective, I can't give you returns.
Or we'd have to kill you.
No, you have to be an accredited investor, and I'm kind of standing in territory I'm not supposed to just broadcast that out. But if you're an accredited investor, we'll certainly get that information out to you. But our returns are going to be within our expected returns that we have listed on our agreements.
Yeah.
Okay?
PM. Yeah.
And then if you're buying notes from us, we charge anywhere from 9.99 to 12, depending on the project and the person and all that stuff, right?
Yep.
Right.
And
Right.
there's other opportunities
Right.
that you can potentially make more.
So
Talk
if
to
you're
us
buying-
offline about
if you're-
that.
If you're buying a note from us, you're getting whatever the rate is that the note
Yeah.
rate was.
Yeah.
Mhm.
Yeah.
I don't
Hold
see
on.
that
Let's
changing.
back up. We got a question about the infill lot. So what is an infill lot? So an infill lot is where you have a neighborhood that's already built or a street that already has houses on it.
Mhm.
They may be old. They may
We'll call
be
it
newer.
stabilized.
but it's-
Stabilized neighborhood.
Yeah, that's a good word. Stabilized neighborhood. And there's a house or a lot that's in between a couple of houses and you're filling in the neighborhood. It's pretty simple.
Yep.
Or it may be in a neighborhood where the house just really needs to be knocked down. You knock it down, you build new. So there's new construction.
So
right
we call that
beside-
refill. instead of
Refill.
infill?
Yeah. Those are
a
refill
refill lot. Yeah.
lots. I like that.
Hey, makes sense.
I like that. That's a good question. I'm sorry. I'm using slang. I probably shouldn't use slang.
So let's see, we got the interest rates, quality. So the quality, every loan that we do undergoes a rigorous due diligence process,
Mhm.
an underwriting process. So we not only vet the property and the feasibility of the property or project, we also vet the individual or individuals who are doing the project. We can say that our underwriting process is in line with most national lenders. Now, we are not constrained to a box. We can think outside of a box.
Yeah.
Well,
we can
when it-
see different. We
and
know the
can,
market.
and we can see different, but we still get certain things that allow us to create a higher quality product.
Right. And
Yeah.
I'm going to mention something too that I actually said to Bill yesterday, but I didn't get a chance to say it to you. We've got a deal now that we loaned some money on, and it is a movie theater. It's over a year old. It's a movie theater, a restaurant, and an out parcel piece of land that goes with all those properties. And I mean, we're only in it at what, 43% maybe of the loan to value on it. But one of the things that I think is so great about this is that the guy really just wanted to buy the restaurant, and you, Jonathan, had him throw in the movie theater, and you had him throw in the out parcel as part of that deal.
Yeah, I wasn't going to finance a restaurant.
That's right. That's
But
right.
who would have known
Yeah.
that COVID-19, like going back, I'm like,
That's
well,
right. That's
restaurant and a movie theater, those are like the two hardest hit things.
That's right. And right in the middle of his refis when COVID hit. So
Yeah.
it kind of, the timing kind of sucked on that. But
And the out parcel is in the middle of a sinkhole.
that's right. That's not true.
That's kidding.
Stop it. That's not true. But the bottom line is, when we're talking about the quality of a project, when we see an itsy bitsy bit of risk or just an unknown, you're great about, let's cross collateralize this with something else.
Yeah.
Just to have have the borrower have more skin in the game, more faith in what he's doing, and a little more protection for us, the lender, right?
Absolutely.
Awesome.
Absolutely. Yeah. If many years in this business has taught us anything, it is to over collateralize.
Yeah.
That's
for sure.
It's just part of it. Now, there's a lot of deals, like especially on single family deals, those pretty much stand up on their own. They're very, I think we'll use the word vanilla. Like this, everyone understands that. It's a smaller group of people and investors who understand commercial. So for us and for a lot of people nationwide, you have to add in some extra security blankets to create that comfortability.
Right. Absolutely.
So
So then we talk about the loan size, the performance, the delinquencies, and defaults, or something I think we haven't talked about.
Delinquencies is someone doesn't pay on the exact time that they're supposed to.
Right.
Default is that they
ain't paying at
they're
all.
not paying at all. Yeah. Yeah. So defaults typically, I think everyone's a little different. The way our loans work, it's 15 to 30 days past the due date is you're in default. But it's kind of standard on a residential, like consumer mortgage, it's 30 days.
Right.
So on delinquencies, I mean, we have, probably, it's like that 80-20 rule. It's less for us, but we have a small group of, I guess we'll call them
Trouble children.
it's just people who, they're not going to pay on the 1st or the 5th. They're going to
just
pay on the 10th
consistently
or the
late.
15th.
Yeah.
And they're just going to do that, and they pay their late fee. And that's just part of how they do their business. Like, there's plenty of people out there like that, and there's nothing wrong with it. Then you have on the default side, when they go, 30 days late, and we have to send out a default letter. Do we have one in default? Do we have it?
I'm thinking since 2017, when we got the big hit. Since that time, we've had 3
loans in default since 2017.
Right.
That sounds about right.
Right. And that's out of since that amount, that's, well over 200 loans.
Yeah.
So that's,
yeah.
that's not a bad, that's not a bad count.
So default, less than 2%.
Yeah. Which is normal. Actually, it's below normal.
Well, and there's an argument to be made. If your default rate's too low, you're not being aggressive enough in the market.
Yeah,
so.
that's true. That's true too. But we'd rather not have any. That's the case.
Yeah.
That's how the market came up with the 125% loan to value loan.
Yeah.
For purchase monies.
Yeah.
So, hey, let's furnish the house and get a new pool while we buy this.
Yeah,
house.
that's kind of crazy though. That's why that's what caused 2007 and 8 for sure.
Mm-hmm.
For sure. But, how do you handle something like that when it goes into default? Our goal is always to get that borrower back on track. The last thing we want is their house or their project or whatever it is that we loaned on. We don't want it.
We will take it. but we don't want it.
That's right. Because we're in the lending business.
Yeah.
We're not in the rehab business or selling the product. That's not what we do. So,
Yeah.
so our goal is to, as Jonathan put it yesterday, drag them across the finish line. If we have to, that's what we try to do. Always try to do that first. If worse comes to worse and we do have to take it back, then we've kind of changed the way we handle things. And our goal is to put that property into a third party receivership, right?
Correct.
Yep.
And why do we want to do a receivership, Bill?
Because as a lender, you're in the lending business and you're not at fault for anything you do as long as you're sticking with the lending business. So going through a foreclosure process, you're having to keep up with the lawn or the taxes or any of that kind of stuff. If somebody slips and falls, you're not the one liable for it because you're not stepping outside of your normal business.
Right.
But as soon as you take possession of the property in your name, and then, which is still okay.
Yeah.
But if you take possession of the property and then you start any additional work to it to complete it, now you become
contractor,
basically the contractor or the investor.
Being the warranty work.
And then now you're, as a lender, you're, just as responsible for any other owner. If there's a slip and fall, there's different liabilities. And then you touched on it. You're now responsible for the quality of the work,
Right.
which you didn't perform.
Right.
Most of it.
Right. Like we're fixing nail pops a year later
in North
on
Carolina.
a property.
It's a year, right?
Yeah. We're
In
fixing nail pops.
California, it's what, 7 years?
10.
10 years. Yeah.
And of course, we're taking the hit ourselves on that. But if it were you, the lender, doing it on your own, you'd have to step up and take care of
And
it.
see, one of the things that we realized quickly when we were taking these back and finishing them up is that no contractor wants to finish anyone else's work.
Right.
They'll certainly buy the property and finish it up themselves. They don't have a problem with that.
And they want it at a discount.
They just want, everybody wants it at
Right.
a discount. I wanted it at a discount.
Yeah.
My point is they'll do it themselves. They'll finish somebody else's work if they own the property, but if they're doing it for somebody else, now they've got a problem with, well, how do you determine if there's a problem that comes back up with it later, if it was the first person that worked on
That's
it or
right.
them?
But it's going to be the latest
So
guy
I
that
get
touched
that.
it that's going to be responsible for it.
So as a lender, you're better off
Going through the
taking it
receivership.
in receivership and then hiring people. And of course, you wouldn't be hiring it. It would be the person that is handling the receiver
That's right.
would be contracting the people to fix
Well, and then
it.
the other thing that we've done, getting back to this first question that we're, pounding into the ground, is we also dropped our loan to value from 70% down to 60%. Yeah, 65% and 60% in some cases.
A lot of the new construction.
Yeah, new construction. It's
really
it's out
run
of our
on
states
on a
and
loan to cost. Though,
yeah,
so.
yeah. So that's going to put us as lenders in a better position if for some reason we have to take it back. It just gives us more wiggle room to be able to
Cushion.
sell that project off through a receivership at a discount without taking a hit. So, I've talked about cross-collateralizing, other property. You want to have as much collateralization as possible so that you're guaranteed to get your money back.
Yeah.
You're never guaranteed anything, but that's going to help promise that you'll get not only your money back, but possibly, all your fees and things like that it cost you to take it back.
Well, and one of the things, want to caution people who are lending on their own is your loan to value. Now, if you're lending at 85% loan to value and your thought is, I don't care because if I have to take it back, I'll just take it back through foreclosure or whatever it is. When you take a property back through foreclosure, it becomes a distressed property. Distressed properties do not sell for the same price as an arm's length property.
That's right.
So if you're lending 85%, there's a good chance that distressed property equity is eaten up just because it is distressed.
That's right.
You might get your money back. You might lose some. You might make a little, but just know that like those distressed properties typically sell for 10 to almost 20% less than a non-distressed property.
And be careful about a deed in lieu versus going through the foreclosure process, because if you've got contractors that have been working on it, they can present you with a bill.
Well, yeah. With a deed in lieu, if before you ever execute a deed in lieu, always down date the title policy, and please have a title policy.
Right.
But always down date it to make sure that if there are any mechanics liens, material liens, or anything else that are on there, that you see them before you take the property back.
Right.
Because when you take it back, you're now responsible.
That's right. That's right. And it can be hairy. There's a lot there to look for, but that was a great question.
Yep.
Great question.
Number two here
Number two
is under what circumstances, Wendy, would you be willing to provide 100% financing where the borrower comes to closing with no cash out of pocket? Stated differently, how attractive must a deal be in order to mitigate borrower skin in the game? Is it 40% LTV? And this would be for a fix and flip.
Okay, so that is a great question. And would I ever finance 100% of the deal? We can all say this answer together. No. No.
I wasn't sure if she was going to say yes. So I was like,
She lost her mind. No. You can't do 100%. Here's the way I think right off the bat. If my borrower can't come to the table with money, whether it's closing costs or a percentage of the purchase price, then that means they don't have money. I'm not lending to somebody who doesn't already have money. They have to have money to make payments. They have to have money to get the contractor started.
Yep.
They have to have money to do business with. If they don't have money, that means they're not very good at balancing their checkbook and budgeting what they need to budget. Got to have a good foundation.
There's something that's always going to go wrong.
Oh, yeah.
yes.
It is very, 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 very unusual that you go through a rehab and everything goes perfectly. Let's face it, watch any of your HGTV shows.
There's an issue in every one.
I mean, that's why they're on there, because there's always some kind of drama that comes up.
That's right.
And
the drama's real. I mean, they make most of it up and make it look like a bigger deal than it really is, but because it's all so real. But
you have to have the wherewithal to be able to overcome those obstacles, because everything that you have done has been based on a subject to completion appraisal. The scope of work has already been budgeted. You can't go back in and redo the loan. So anything extra is going to have to come out of your pocket. We have to show that you have money in your pocket.
That's right.
So here's the old bank adage. I can't lend you any money. You actually need the loan.
The thing is, like, because
we're not that tough.
Just earlier we said we don't want properties. That's not what we're in this business for. And whether it's true for your particular project or not, the perceived risk of someone who has no money in the deal, if something does go wrong, which we just confirmed here,
it always will. Do
you have the financial wherewithal to move through that? And if you don't, do you just walk away and now we're left with the project and the property, which we don't want? So, it's kind of that kind of logic that we're thinking of. We don't want the property. We want to make sure that you get through this project so we never have to step foot in this property or take it back.
That's right. And people will say, well, if I have to bring all my money to the closing table, what money am I going to use for the rest of that stuff? Or I have money to take care of the contractor and to make the payments, but I don't want to bring money to the closing on that. I only have a 40% of the as-is loan value. I'm only needing to borrow 40% of the as-is value of the property. That's great. That's great. You're in a deal really, really at a good position. But bottom line is, we don't want your deal.
No, we don't want to manage properties. We don't want to list properties. We don't want to rehab properties. That's why we're lending you all the money.
That's right.
So you all can do those
That's
things.
Exactly right. That's exactly right.
And even back when we were doing 70% of the after repair value, and you could, and we were doing 100% of your
purchase and rehab.
Right. you still had to bring money.
Yeah, you had to bring the closing
you still had
costs.
to bring the closing costs, the points, any kind of fees.
Which usually
had to
came
pay
out to
for your
like 7 or
appraisals
8% of the
Mhm.
project.
8%.
Yeah.
So you still had skin in the game,
Mhm.
and we want to see a little skin in the game.
Yeah.
Well, the thing is, you know, everybody who has a little bit of interest in investing, you know, wants to dive in head first. And they want to, you know, they want to be an investor. I think that real estate is investing is the most awesome career that anybody could have. I love this business. I
Yep.
love it. And I want everybody who wants to be in it to have that opportunity to be in it. But you are not going to do well if you don't have a firm foundation to begin with. You've got to have a rock to stand on. It can't be made of sand, because there's all kinds of things, bad things that are going to happen. Multitudes of bad things are going to happen, and it's going to happen over and over again. You're going to learn from this project, then you go to the next project, and all kinds of new bad stuff is going to happen.
Yeah.
You know, I've been doing it 20 years, and I still step in all kinds of piles of dog poo, as I like to put it. I still can lose money on a deal. I can still make bad decisions on something.
Sure.
I can still misjudge what I think that house will sell for. I mean, there's all kinds of things that can happen, and you have to be ready for it.
Mhm.
So, you know, if you're wanting to get into this business, you have to have a foundation of not only some money, but you need the education too. You've got to
Absolutely.
be plugged into groups of other people that do this.
And honestly, the education first and foremost. I
Mhm.
mean, you could.
Which is why we're doing this.
Yeah, you can have the money and you can lose the money. I mean, the education gets you to the place where you can manage your money and manage the project.
Right. And you
Yeah.
meet other people who are already in the business that are willing to take you under their wing and teach you what you need to know. Everybody brings something to the table, even the person who knows nothing.
That's one of
Good
the things
questions
I was going to
usually.
mention.
Mm-hmm.
No.
How do you get started in this thing when you don't have any money? Well, you work with a mentor. You
Mm-hmm.
bring deals to the table. They will find the financing for you. Are you going to have to give up probably half of it? Yeah, but that's how you learn.
Yeah.
I know
50% of
Larry-
something's more than 100% of nothing.
That's
Goins-
exactly right.
Larry Goins used to always say, you earn while you learn. That's better than paying to learn.
Right?
Yeah.
Absolutely.
Yeah, that's right.
Looks, we have a question. What if you already own the home? What money do you need to bring to the closing table?
Awesome.
Great question. So there's two different scenarios here. One would be a lot. Do you own a piece of land? And in that scenario, we can finance the lot plus the construction, and we can finance the lot at 50%. So you have to hold 50% of what you paid for that property into the loan.
Mm-hmm.
On a house, you would, I mean, depends on what you need. If you're doing like a fix and flip, you already own the house. We wouldn't probably require any money down for the house because you already own it.
Right.
That'd be crazy. We would fund you the rehab money.
Right. But we wouldn't give you money for the house.
Correct. We wouldn't give you money for the house, but we would fund you. So you wouldn't have to bring a down payment or anything like that. You get the rehab money because you already own the house.
Yeah. Now, if you paid cash for the house on an auction and you wanted to try and get a loan for the whole thing, on a case by case basis, we'll talk about how much of that house we would may reimburse you for. It really depends. And that's what's so great about being in the business that we're in and knowing the areas that we know, because we can really make a decision based on the area, based on the house, based on the total numbers, based on you, your history, your credit history, your background check, all the things that we're looking at. Your experience means a lot. It means a whole lot.
And one of the things that we constantly look at, and so everyone's aware, we look at the life of the loan with an expected draw schedule, and what is our LTV, our loan to value over that life of the loan. Because we want to make sure at the beginning we're at X, and at the end we don't exceed Y. So, we have to make sure that through that life of the loan, we are managing that project so we don't exceed a certain LTV.
Right.
So that's how we're looking at these projects. They're based on mostly LTV.
Right.
Mm.
Exactly.
I got nothing else to say.
He's got nothing.
Yeah.
He's got nothing. This has been great. There have been great questions. And we appreciate you guys taking your time. I hope you're all, eating a sandwich while you're listening.
Yeah,
Somebody
something that
having
I'd like to
lunch.
be doing.
Yeah. You can, but we'd have to turn your screen off.
Yeah,
So
I know.
it's-
Again, we are Carolina Capital Management. If you want to find out more information about us, CarolinaHardMoney.com.
That's right.
If
Has
you're a
been for
borrower-
years.
Yeah.
I get it wrong every time.
And it's still the same.
If you're a borrower and you're looking to borrow money, then click on the borrower tab. If you're an investor looking for passive returns, click on the investor tab. And don't forget to share, like, subscribe. If you think of any other questions along the line, just ask it inside the panel there. We have someone that scours these things and we add them to the question list afterwards.
Awesome.
Okay?
And another thing too, thank you,
Thanks,
Lisa.
Lisa.
That's really sweet. But another thing too is we talked about education and how important it really is. If you've heard me speak at all, you've heard me talk about how important it is to join your local real estate investor group. It's important to go to the smaller subgroups that branch off from that. It's really, really important because that's where you're going to meet other investors. That's where you're going to meet other wholesalers, other lenders, other contractors, other people that you can build your team that you need to build. That's the person that's going to take you under their wings, because I can tell you the people that have the money are the ones sitting at the back of the room with a piece of straw and overalls, piece of straw in their mouth and overalls. And they're the ones that have all the money. They're just looking for the movers and shakers. They're looking for the people that know what they're doing.
Look
right?
for the people who are trying the least hardest to impress others.
That's right.
Those are the ones you want to talk to.
Yeah, they've got the private money.
Yeah.
And they're the ones you need
And
to
that's
do.
not to say you don't go to the main meetings.
Yeah, because they're good too.
They're good
Absolutely.
educational value there.
Yeah.
But to really meet and establish relationships with folks, you need to go to the smaller ones.
Awesome. Yeah.
Last question. Do you have any no cash out refi products for investment properties? I have a call right after this, and I will answer that question shortly.
They're coming back, but they're coming back really slowly. And we've got two companies keep threatening to bring us a couple of good loan products. But right now they just really stink bad.
And you remember what we were just talking about, how the buy and hold real estate investor is probably the least risky.
Yeah. And
these are the buy and hold expert lenders
Yeah.
that don't want to lend.
that's for sure. So what we're telling people right now is you need to check out your small local banks. They're the ones that will most likely do those refinances for you. That's what I'm doing.
Yeah.
That's where I'm taking my stuff.
Are you getting a 20 or 30-year AM?
I'm getting a 20-year AM.
Mhm.
It's a 5-year renewable. They treat it just like a commercial loan. And that's how you have to approach your regional lender, your local lender about that, is you need to tell them you're looking for a commercial loan because you want to leave it in your LLC.
Yep.
So you want to talk to a commercial loan officer, not their regular loan officer. So they're going to give you a 20-year AM. It's renewable every 5 years. But you know what? Right now, that's the best you can get. So take what you can get.
And the rates that I'm seeing are, between 4 and 5%.
Yeah,
from
yeah,
a lot
they
of
don't-
those.
they
They're
don't
not- they're not
totally
terrible.
stink.
Yeah, they're not terrible.
And then I know there's a private or a hard money company called Lending One, and one is spelled out Lending One. And I know they're back doing their long-term refinance. I don't know that the rates are very good. I do know that your credit scores have to be, off the charts good.
Most of them are 700 plus.
Yeah, or 720.
And
So
I think they're focused more on the multifamily.
yeah, and they might have they might have guidelines based on what the property is worth, and like that at least worth 100,000, that the loan amount has to be at 75. So there's little things like that could pop in and mess
Right.
it up.
So
But anyway,
we have to go.
Yeah,
'cause
yeah.
We're going to be running out of time here.
I know. I'm sorry.
All right. It's funny. I'm usually the one that's running off.
It's
this
Yes,
stuff.
CarolinaHardMoney.com.
Yeah.
Bill Fairman, Wendy Sweet, Jonathan Davis, Carolina Capital Management. Again, CarolinaHardMoney.com is our website. Don't forget to subscribe, share, and like us. And we'll talk to you guys next week, same time, different
Or
link.
in 10 minutes at,
But you'll get
at
an
a little
email.
after 1, right?
Yeah, we'll have one here shortly.
Yeah.
Yeah.
Absolutely.
At
Great
one.
guest too.
Chandler George,
Have a great day, guys.
what he
and
said.
gals.